First rates then on your screens right now, and it's a very, very tempered start. Let's see what direction the markets take from here on. Let's start off with the earnings reactions. First on L&T, because that's going to have a bearing on the index as well, given its weightage. L&T starts off 3.25% lower right now in trade. Although while the numbers were a miss, they have raised their FY24 order inflow guidance all the way up to 20%. But no, the market is not reading into that 4% of a dip coming in for L&T. DRL as well. The Q3 numbers were a beat led by the US sales. The India business is an uptick of about 5%. Very tempered a move coming in for DRL right now. SRF, Voltas, all have been disappointing numbers, so look out for that as well. I want to see what Star Health is up to because they too came out with their numbers, as was the case with PB Fintech, wherein the core business revenues have come in higher by 40%. The contribution of the margins has been up by 400 basis points. There's TCS as well, which has signed that 15-year deal with Aviva. Reports are saying that the deal size is a mammoth $2.5 billion, 0.5% higher for TCS as we speak. Where's the pinpoint Reliance Industries? Let's see what that stock is up to. Holding up in the green of about almost 1% as I see it right now. But I think it's a bit of a tug of war with L&T on one end and Reliance on the other. Reliance really not being able to do all that heavy lifting, even though the stock is still holding up 1% in the green as we speak right now. The government has cut the import duty on mobile phone parts. Dixon Technologies is the stock that we should bring up for you on your screens because that's going to have an immediate bearing. Or for that matter, I think Reddington as well eventually. But yeah, the more near-term impact is going to be felt by Dixon. That stock is holding up as we speak right now. But that's pretty much it. Where else are you seeing any varied reaction, if at all? Voltas, they've reported a loss led by projects business, so look out for that as well. Let's see what SRF also is doing. The margins have declined in the chemicals as well as the PFB business both. So that's going to be another stock which is going to be in focus. There's of course Cochin Shipyard, which also came out with its numbers, and given the tilt of the market which has been so skewed towards the defense names, 5.5% of a gap up coming in on Cochin Shipyard, and I don't think that stock is going to abate any time. The margins came in at 29% versus a comparable of 23%, and the revenues also have seen a mammoth uptick of 64.5%. So for all those naysayers who thought that these pockets have run up ahead of the fundamentals, clearly not, because the growth numbers seem to be justifying that kind of a parabolic move. But Kunal, what's your sense on which way A, the index is going to move from here, and B, any trades if you're punching in right now?
So yeah, again, the trend on the index is a lot more sideways. Sideways in the sense that we are more stuck into a range, a broad range for the index, some 700, 800 points on the Nifty. In terms of opening trade, I think L&T Finance is something which looks attractive. Over the last few days, the stock has managed to make a very strong comeback from 155 mark to now on the verge of breaking about 170 levels, expecting the stock to perform exceptionally well going forward with a potential target of even 200 over the near term. So would be bullish on L&T Finance.
Okay, speaking of that group of stocks, it's L&T that's reeling under pressure, of course, on the back of those numbers. It's a 5% gash. Naresh, a quick take on what one should do with L&T at the current levels and your first trade.
So would wait out for the last low zone of 3300, 3350, which is where I think it should reverse from. And that is where the risk reward comes into play. So for now, would wait it out. My pick for the day continues to be Container Corporation, which looks promising on a structural chart.
Fintech as well is clearly cheering those numbers. Those initial trades are reflecting that the stock price has crossed its pre-IPO levels, so clearly giving a thumbs up. And remember, brokerages as well are optimistic. Naresh, why don't we get in a take from you? Do you track PB Fintech? Where is it that you expect the stock to scale up from the 980 mark?
This was one of the first ones which actually gave that breakout after consolidation. And the trend is just starting up because, say, the stock topped out around 850 levels back in August, and since then it was a slow and steady ride. So it looks like the next target price could be closer to 1050 to 1100 for the stock.
On the cards when it comes to PB Fintech. Meantime, just checking in on the broader universe and names like Cochin Shipyard, as Aisha highlighted, that's up to its winning ways. There's a Garden Reach that's in the green, Rail Vikas Nigam. What's happening with this cluster of stocks, Kunal?
Well, I would believe that it's yet another round of rally for many of these names. Cochin Shipyard specifically, the stock which had given a very strong bullish candlestick move. I think on in the first week of January, when the stock had moved from 650 levels to 800 in a matter of a couple of trading sessions on the back of some very strong volumes, has now moved from 800 to now 900 after a bout of consolidation. So very strong trends coming out for many of these names, and I think the best strategy over here is to try and keep a trailing stop loss. Maybe a 50-day moving average is a good trailing stop loss for many of these stocks and continue to ride the trend.
By the way, PB Fintech, with that big spurt in the stock, has managed to cross its IPO price right now of, I think, 980, 983 thereabouts. 993 is where that stock is. In a tissy, 9.25% of a move coming in, but not quite for the index. But let me take it across to Nikunj, and he's got none other than Madhusudan Kela in conversation with him. Nikunj, take it away.
To talk about potential of Indian economy in Indian stock markets 20 years ago was more like an idea. It was a minority view. But today, there is a consensus agreement on the potential of India, the way forward, and Indian stock markets, why they deserve a pedestal positioning. Now, why am I bringing up this conversation, which I had with someone 20 years ago? Because the guest on my show today, someone 20 years ago told me that bet on India. And I coined this phrase after I met him, the man who saw tomorrow. So who is that man who saw tomorrow? Well, that's Madhusudan Kela, who is going to be talking about literally tomorrow, because tomorrow is the budget day. Yeah. So Madhu Kela, thank you for joining us. Always a pleasure, always a delight to have you.
Thank you, Nikunj. Always pleasure talking to you.
So what are we starting with, sir? Are we starting with the budget, or are we starting with markets?
It's always, you are the driver. whatever you want to start with.
Well, we've got you on that time of the show, that time of the year where budget is important.
Yeah.
Over the years, even though the importance of budget has got diluted,
yeah,
and surprise is that there is no surprise, but markets, they tend to use that as a benchmark to judge the future.
Sure.
What is your understanding of this year's budget?
So I would say, I would agree with you, Nikunj. Budget used to be a very big event, let's say 10 years back, when there were a lot of duty changes, a lot of policy changes, a lot of taxation changes. You know, there used to be a lot of tariff changes in the budget. But over the years now, specifically in this government, your policy changes around the year. So this is not a budget-specific exercise. So from a market perspective, obviously the importance of budget has diminished significantly. It is now lasting not more than 2 days of this kind of conversation. This year it is anyway vote on account, as they say. But I wouldn't be surprised if it is a full-fledged presentation of a proper budget, given that the government is confident of continuation in the next term, right? So, but do I expect any major surprises? I don't think so. Government has done a fabulous job, given the volatility in the global markets, of consolidating the fiscal situation. I think the target fiscal deficit of 5.9% should easily be met. If not, if we don't do better, there is a possibility that even we could do 5.8%. Government is in a very, very good situation. They have controlled the expenditure, revenues have gone up, the cash deposit of government with RBI is over 3 lakh crore rupees. So they are in a very good fiscal situation. There is no major surprises during the whole of last year, right? Now, because it is an election year, there is always that fear in market's mind that there could be populism in this budget. You know, given the track record of Modi ji over the last so many years now, I for one do not believe that they will go really out of the way to make it very, very populist. There will be some tweaking of some schemes here and there. But I don't think there will be a lot of tweaking. And frankly, Nikunj, we have come to a stage when market doesn't even care whether the deficit is 0.1, 0.2%, higher or lower. As long as the policy predictability is there and government wants to stick to the larger fiscal consolidation path, I don't think is going to be a very major issue, even if they announce some larger populist measures. So all in all, very good. The quality of budget should be fabulous according to me, given that the capital expenditure CAGR for last 3 years has been very, very high.
30% actually.
30%. I would expect, even next year, capex to rise by 20% at least. This is the best thing which this government has done, that quality of expenditure, while the revenue expenditure is rising by 10-11%, capital expenditure is rising much higher, and that is what we need from the government.
Okay. So, budget is still about assumptions. Let's look at the maths just to understand that, what the directional call is. The fiscal deficit number for this year, there is no problem on that.
Absolutely.
For next year, do you see it moving closer towards 5? Looking at the realistic assumptions?
I would not say it will go to 5 because, this year has been a very good from a government perspective. And again, given their track record, I don't think they will make very aggressive assumptions. They have learned the trick that, under promise, overperform. That is what really makes everything. I think it may be close to 5.2 to 5.4.
Which is fairly acceptable.
Fairly acceptable. Fairly acceptable, I would say, with a guidance that, when July, when they come back, and with the guidance that 2026, they are still sticking to that 4.5% number. So that, Nikunj, I want to tell you one thing, that after they come back, one thing which has not worked for the government is on the public sector, whether disinvestment, dividend target, that has not worked in last few years. Either they have not met those targets or they have not been possible. That is what could be a big surprise, when we get into the next year and year after number. Because now you see, with 50 lakh crore rupees of market capitalization of public sector companies and government ownership on a weighted average being more than 50-60% cumulative of all PSUs put together, which was merely 13 lakh crores. So the government wealth, which was maybe 6.5-7 lakh crores 3 years back, has gone to 25-30 lakh crore rupees. So there is a big delta which has come. Now you could give higher dividend, you could sell stake in stock in companies where your holding is more than 51%, or you could strategically divest. So that is one surprise I think will come once the new government is done, and that is what gives me personally the confidence that fiscal consolidation path is there to be adhered, and this is one weapon which the government has, which they can use any time, given how much buoyancy is there in public sector companies.
If the assumptions for tax collections, both direct and indirect, are in and around the nominal GDP, now we can argue 10 or 11 or 11 or 12. The only difference is it has to be in double digit. Is that a reasonable assumption on a higher base also?
Yeah, I think it's a reasonable assumption, and they will do. They will target to assume maybe 330 lakh crore rupees of GDP for next year. I think it's a reasonable assumption, and we are seeing that India, even in a troubled year, have actually outperformed anyone's prediction, including this year.
Yes. Even RBI has come out and increased the guidance.
Including the GDP prediction. I see no reason why, with policy stability and continuation of what we have been talking, I see no reason. And Nikunj, let's not forget what the world environment is ugly, right? Markets are very buoyant. You are talking of $34 trillion of US debt, which is equal to maybe 1.2, 1.3 times of GDP. So I think, India is the bright spot in the world. So there is no reason to believe why we can't assume 10-11% kind of a nominal GDP growth rate for next year.
Okay. A very interesting graphic which has come from your research team, and I just want to showcase it for the benefit of our viewers, is that let's look at the aggregate capex. 50% of the aggregate capex, well, that has moved into roads and railways. railway capex, road capex is up 8x, railway capex is up 2.5x.
That's right.
Assuming that the capex number would be strong and it would be north of 10 lakh crore, that means road and railway will continue to get that booster shot.
Yeah, absolutely.
If that will continue, then can I say that for road and railway stocks, still there is a long way ahead?
I think I would not say for railway stocks. See, there is a difference between good news and stock price, right? Railway stocks have run really hard. You know, that has been the best performing sector. So, can there be fireworks around the around the announcement of the FMSP? There could be fireworks, but I would be very careful in investing into railway stocks. I am not saying there is no let's take a view on this. You know, if you are a 5-year, 10-year investor, there is still a lot of value in a lot of the PSU companies. But if you are looking at, let's say, next 1 to 3 years, given how much run-up has already happened in a lot of these names, I would be very careful in investing in some of these companies. When you come to infrastructure companies, when you come to EPC companies, which are building roads, which are building infrastructure, there still we see a lot of opportunities because A, there is significant under ownership. There is no signs of any euphoria there. Valuations are still very attractive. The order book position of all of these companies have swelled to a life high. You know, just to name, like Nagarjuna Construction today has the order book of more than 60,000 crore rupees. I don't mean to recommend this stock, but we are just
illustrating
speaking in the context. So there is a lot of opportunity in that basket we see, not necessarily with the railway companies.
June 2020, 3 years ago, Madhusudan Kela was perhaps the only or the few amongst bulls who said that I'm going to buy PSUs. PSUs that time were considered to be more like an ugly duckling. Nobody wanted to buy PSU stocks. Today they are the darlings of the market. How much of the re-rating in PSU stocks is over?
So I would say, Nikunj, a lot of re-rating has happened. But, you know, one thing is clear that they are the leaders of this bull market. PSU as a basket, as I gave you the number, you know, it was 13 lakh crore rupees 3.5 years back. It is more than 50 lakh crore rupees in terms of market cap. Clearly no other sector where the market cap has quadrupled in last 3.5 years, right? So they are clearly the leaders. Was there a significant undervaluation when we were speaking at that time? There was. Today, that undervaluation is not there. It's a sector which is discovered. But why I am saying that I would still be very open to buy PSU stock if I get any either meaningful correction or a good idea. Like I am still very bullish on PSU banks. Select PSU bank, they are still trading at 5, 6, 7 PE multiple, you know, 1-2 year earning forward, while the lot of other PSU stocks have gone to 30, 40, 15 PE multiple. Now this doesn't go in my head. That something is wrong. Either they have to go up or those stocks have to come down. So you will have specific opportunities within the PSU basket. I would not say that entire PSU is a buy or a sell. However, in select names, like we spoke about railways, I would be very careful. You know, if you have to put money, you should do your homework very properly. And now, of course, if you are an investor, already an investor, you have to take a slightly longer term view. I don't think a lot of money in a lot of PSU names will be made over the next 1-2 years.
One looks at the numbers from HDFC
And
Bank.
again, let me give
Yes,
one surprise.
Yes,
again, what could take the PSU market by surprise in terms of this PSU rally? Let's say the new government comes and they say that we are going to make 5 strategic disinvestment. It has not worked till now, but we are on the job. We have absolute majority, and if 5 or 10 companies get disinvestment, then it's a party time.
It's hard, but it could happen.
It can happen. But if you ask my hunch, I have no information, but my judgment says that it's more likely to happen than not likely to happen.
Because government has already said that they would like to be in businesses which are strategic in nature. They do not want to be in businesses. Government's business job is not to run businesses which are non-strategic.
Because what we know is only the price of PSU stocks. What market doesn't know is what is the intrinsic value.
Yes.
Like, do you know what is the kind of real estate holding with the State Bank of India will have? Or do I know what is the real estate holding of LIC will have? So there is a lot of intrinsic value in a lot of these companies. So we don't know. Once when your strategic disinvestment happens, at that time you look at the strategic value of the asset. So that is really joker in the pack. That if the government comes and shows that intent that they want to do, then there are still legs in the entire public sector companies.
If one looks at HDFC Bank numbers, the kind of commentary we are getting from ICICI Bank, everybody is feeling the pressure of deposits. The liability cost is hitting them. This is where you think PSU banks would score because they have such a fabulous branch network and old relationships. The deposit advantage will always be there.
Nikunj, my friend, this is what the market is showing, right? Last 3 years, all the stalwart private sector banks are struggling. The CAGR return is below 5% in most of the big names, barring one or two. Right? But if you look at bank performance of public sector banks, they were very cheap, and this is the case we have discussed many times. This is the case which we made that ownership is very, very high in a lot of private sector banks. Ownership is very, very low in public sector banks, and the valuation gap is very, very wide. And given that there is 85-90% coverage ratio, which has already happened, I see no real worry on the asset quality side. I think we are halfway through that, even though the PSU stocks have run very hard compared to private sector bank. I don't think the re-rating is fully done, and there is no sign of any euphoria here.
So can I say that the easy part of the bull market is over, but the hard part of the bull market will start, which could be volatility and it could be sideways
Honestly, Nikunj, there is never an easy part. Market making money, all 800 crore people in the globe.
But the way you invest, you make it sound so easy.
But when you have to buy, see, you have to have a lot of conviction. So I don't think it's ever easy. But having said this, if you are investing 3 years back, the chances of you going risk reward was disproportionately in your favor. Today you have to be very careful in what you are investing. We are still able to find ideas and make money. But obviously there is a greater risk, and the number of ideas which we are able to find are much fewer as compared with what we were able to find 3 years back.
A year ago we spoke about real estate.
Yes.
And the stocks have done rather well.
Yeah.
Do you still like them?
Selectively, yes. You see, again, now I am saying, I am not willing to make a commitment today to you that what will do well in the next 6-12 months.
Okay.
I don't know, honestly. So whatever I am buying or we are investing, we are taking a slightly longer term view. Think that we have to hold maybe for 3 years. Maybe the phase of the market. I today, as you were saying in your opening remark, everything looks so picture perfect.
Yes.
So as an investor, I have to be careful that what could go wrong. What can go right, everyone is talking about. But what could go wrong? That reason I don't know. Only after the market. And my base case is that not the markets will correct, but there is a possibility that it will correct. And the reason, no one will knock my door and say that this is the reason market is going to correct. The reasons will not be known. But because we have made so much money in the last 3 years, and it is always, the markets will always revert to the mean. They will always revert back to the mean average of return, how much money you can make. So some reason will come. Most likely it will be a global reason. But the point is, if there is a correction, and again let me repetitively say, I am not saying there will be a correction, but if there is a correction, people like me are fully prepared. Nikunj, over the last 3 years, what we have done, we have delinked our research from execution. Research is separate.
Great.
We have to be prepared with a price that if the price comes in this particular stock at this price, we will buy. So we don't execute when we do research. We execute when the price comes. So we have to be prepared. The long-term India story is fabulous. It is getting better. So if you ask,
that's the word coming in from Madhusudan. Kela, India is a bright spot. It will be a party time for a lot of those PSUs if the government decides to divest stake in 5 to 6 companies, and lots of other key takeaways about how capex as well is going to rise substantially, nearly 20% in the next year. No major surprises though expected from the budget, and they have consolidated the fiscal situation quite well. Well, what's going on with the rest of the market? We're holding out 21,500. It's PB Fintech in the spotlight, and they have reported a profit for the first time ever. Ajay Sharma caught up with Yashish Dahiya as well as Alok Bansal of PB Fintech.
See, we on our business, we have about 40 to 45% contribution margin. What that means is every time we do 1 rupee of extra revenue, 40 to 45 of it comes into contribution. And below that is our fixed costs. And I think that is what is called operating leverage. That as your business expands, you contribute some amount to it. So if you look at the first 9 months, our revenue has expanded by about 500 crores. But of that 500 crores, 170 crores has flowed directly into the EBITDA. And I think that's what's telling, right? That 34% of your revenue is flowing directly into EBITDA. That's what's called leverage. So as you scale, you become more and more profitable. One thing which is very clear, if you take a 9-month view, don't look at it just quarter by quarter. This is not a profitability which has been achieved by controlling costs. So sales costs, marketing costs, nothing has been brought down. It's a very straightforward business in that respect. The second thing that happens is as time progresses, because the brand is evolving, consumers' trust is evolving, the conversion rates keep improving, our technology efforts are higher, our efforts on creating better products are higher, better products and better insurance products for consumers. So the conversion rate slowly keeps inching upwards. We are not disclosing, but the premium per inquiry is the way we look at it, is significantly higher than what it was last year, which was significantly higher than what it was last year, right? And I think that means that every year you're getting more and more efficient. Now, this year, actually, if you ask me, our profit and our contribution is understated by about 2%. And that is because health has grown a little faster, by a 20% faster than the growth of the overall business. If the overall business has grown by X, health has grown by X plus 20. And in the first year, we make zero contribution on health because health is a renewals revenue business. And so if you really think about it, if health is 25% of our business and we grow 20% faster, so you got a 5% additional growth on health. You're a 40% contribution business, but on health, you're making zero. So you're losing 40% on 5%, which is roughly 2%. Right? And that is exactly why our EBITDA is actually, so if instead of health, we had grown on all our other products in a combined manner, our EBITDA would have been 2% of revenue higher, which is about, on 870 odd crores, that's whatever it is. But that's broadly the difference. And that's the real ingredient. The second part is renewals. As you get older, your renewals become larger. And they contribute, they have a higher margin than fresh business because you put in a lot of effort in fresh business. You cannot get renewals without fresh business, of course. And as I said, in health, we don't even make money on the first year, right? Because you have put in all the effort and you hope that the customer will stay with you for a long time and so that you will reap the rewards of your effort over the coming years. So yeah, it's really that.
Yashish, just a quick follow-up on that point, which you spoke about, operating leverage. It has started kicking in. Do you see this, the beauty about operating leverage is that once it starts, it only gains momentum. So can we assume in your phase of the business also that it started kicking in, it may only, the momentum may accelerate in the next coming quarters? Is it okay to assume that?
I think a very critical thing that people should look at the last 7 quarters and see how much has, for the core business, right? Leave out the new initiatives. For the core business, how has EBITDA moved? And you will notice it has increased by more than 50 crores every quarter year on year. So that means for the year, it's always grown by more than 200 crores. Now, that is the operating leverage. So as you said, once operating leverage kicks in, it has been kicking in for the last 2 years. And our core businesses have not just been profitable, our core businesses are significantly profitable. They have about 12, 13%, EBITDA margin right now. Now, the reason why our profitability got delayed were two. First of all, we started new initiatives at IPO. Most companies were trying to go towards profit. We were moving away from profit because we felt new initiatives were very critical for the long term of our business. So we actually expanded losses through new initiatives. Our losses on new initiatives, even this year, will be almost 200 crores. So what am I explaining? We have made profits despite 200 crores of losses on new initiatives. So the core business is at 200 crore profit already, right? And I think that is what is the real mix here. Of course, as they mature, new initiatives stop making smaller and smaller losses also. So it becomes a kind of double treat. The third aspect is our ESOPs. Because of accounting treatment, they were stated as very high in the past. And we had pointed this out that as time progresses, they will become lesser and lesser, less and less critical or less and less. So that is also playing out. So all these three factors will lead to, in my opinion, higher and higher profitability as time progresses.
Excellent. That's good news for shareholders. Alok, now that this major milestone has been achieved this quarter, the profitability, it stands out. Is it okay to assume, many of the shareholders are talking about it already, that the 1,000 crore profit guidance which you had given, that may actually be achieved earlier than estimated? Are we moving fast towards that? Would you like to stick to it, give some timelines?
Nothing of that sort. See, we have delivered 1 quarter of profit right now. And the journey from here to 1,000 crore is still, takes 2-3 years time frame. It's very tough to predict that it will happen a quarter earlier or a quarter later, but we're very, very focused as a team that we continue to do what we are doing today in more and more efficient way. We've always maintained that profit in our business was inevitable. It was just residing in the back book. What is most important is that eventually the business needs to grow faster. It needs to solve for the customer's problem. It needs to create better book of business for our partners. If we continue to focus on these fundamentals, I don't think profitability was a very, very big concern, anyone who understood our business. And we would not like to change our sort of guidance that we had given that we want to achieve 1,000 crore PAT profitability in FY27. We will stick to it right now.
Alok, at the top management level with this kind of a performance under the belt for the quarter, the kind of commentary which we are hearing from you all, what will be the strategic areas of focus if one were to talk about, say, 3 to 4 quarters far out from between now and the next 1 year?
See, in our, it depends on what you call strategy. Our business changes every few years. If you really think about our business, when we started, we were an advertising and marketing company. We were mostly lead generators for insurance companies. Later on, we became a sales company. We became a fulfillment company. Then we became a data company. Then we became a tech company. Then we became a data company. And this may not be visible from outside, but from inside, when the insurance companies deal with us, they see that change every 2 to 3 years. So we keep changing along that path. And we'll keep getting deeper on that path, right? Our job is to serve our customers more and more. We have got, in the last couple of years, what you have seen is a heavy push on claims assistance, etc., etc. We have applied for an account aggregator license. We are, in the process of thinking about payment aggregation. We have applied for, a reinsurance brokerage license. All of these are signs of where we will evolve to and how we will make our business deeper. We have an investment in Visit Health already, which is an outpatient and a healthcare portal. So we are also making progress on that. We already own 40% of that company. So these are all strategic pieces coming in. So what you will see us do is get deeper and deeper with on our services. and control more and more of our service layer so we can give a better experience to our consumers. Of course, that will mean you will control a little more of the value chain one way or the other, or influence a little more of the value chain. But what we will not do is we will not ever compete with our partners. So we will not become an insurance company. We will not become an NBFC. That's really how we will operate.
Alok, how are things shaping up at Paisa Bazaar? You had indicated earlier that the growth will be slightly slower there. How are things shaping up? Because there is also a regulatory glare out there, the speed at which consumer loans, especially unsecured ones, are being dispensed.
Yes, you are absolutely right. See, we were never part of the huge growth. So we never grew 200, 300% a year, right? We were always growing at 50%, 40% a year. And that story has been consistent for the last 15, 16 years. So, as they say, when a big shift happens, everybody gets impacted. So yes, the regulator has raised concerns about personal loans, while, as I said, we don't do the sub 50,000 rupee personal loans. We are mostly in the 2 lakh, 3 lakh rupee personal loans category. But even lenders cannot even be seen to be, business as usual. When a regulator points out that, look, I think there's something that you must look at. So the boards of companies have to look at it, even though they do not see anything immediately, right, in our portfolio. And so that implies there is obviously a slowdown in pretty much all the partners. Plus, there is a cost, an incremental cost of lending on the personal loan side. So that does, temper the market a little bit. And as I said, 10% lower growth. So if we were growing at 40, we'll grow at 30. I think that's how we think about it. If we were last quarter, we grew at 36, we may grow at 26 for the next quarter. We can't be that specific with guidance, but that's broadly how we see it. We also expect it to be a quick one. The reason we expect it to be a quick one is I think we are 1 month into it, probably it'll last another 2-3 months, is because we see, look, how do banks make money? They have to, unsecured loans is a great way to make money. And eventually everybody is sitting on large bases of deposits. So they have to come back on this. And there we can see lots of new entrants coming in here. And we think it obviously takes time in onboarding new partners and in getting existing partners to become aggressive again. But I think we should see that by the end of this quarter.
All right, there you have it. That's the view coming in from the management of PB Fintech, and they're talking about how they are looking at profitability, which has not only been achieved by controlling costs, but a contribution that has been understated due to faster growth in the overall health. Losses for the new initiatives, though, that has accumulated to about 200 crores, and their profitability will only inch higher. No wonder then that you're seeing that kind of a reaction on the stock price. 1014 as it's scaling and moving from strength to strength in trade today. All right, let's get a move on then. There's another important set of numbers to track, and that's KPIT Tech. You've had better productivity, which has led to pretty healthy growth in the quarter gone by. Joining in right now is Kishore Patil. He's the CEO of KPIT Technologies here to discuss numbers. Thank you so much for taking time out. To begin with, you require nearly 2% cross-currency growth in Q4 to achieve the lower end of your revenue growth guidance of about 37%. Post achieving 44% cross-currency that you have in the 9 months, are you being conservative with your guidance?
So first thing is, I think we are one of the few companies who give guidance, and we revise it only once in a year when there is a substantial change. And we have already said that it will be 37% plus. So I think, we will. We are not giving a quarterly guidance. That's not something we do because I think we like to track things year on year, and that's what we do. So I think it is from that perspective, and obviously we have done well, and we are likely to exceed the numbers at the end of the year.
That any sort of estimation as to what you would exceed the guidance by?
So that we don't, as I said, we don't give a quarterly.
I tried my luck. Okay. Going forward, what would be your outlook then in terms of your cross-currency revenue? Because that dipped a bit. The PV revenue in booking continues to look strong. What is the outlook in terms of efforts that you're making on the CV front for the ramp-up?
So I think we have a pretty good outlook for next. We always say that we believe the environment is very good. The overall market looks very good. We are in a very good position. Our clients continue to spend. During this quarter, we have added about 800 people, net addition in the quarter. It just shows the confidence and the preparation we are doing for the future growth.
Kishore, what are the incremental revenue opportunities you think arising from your sodium-ion battery technology?
I must say that, we do many things, right? And one of the main thing for us is sustainability is at the core of KPIT. I mean, if you know our vision and display, the cleaner, smarter, safer world. And we continue to invest into sustainability and clean tech. Whether and when the revenues will realize, what kind of models will come, that in due course we will factor it and we'll know that. What is more important is right now there is the over dependence on the current battery chemistry and also over dependence on certain countries which are, if I would say, less reliable, and too much concentration in the hands of countries. So it is very important for India, for the rest of the world to find new technologies. So we believe that what we have done is great. How it pans out in terms of revenues, and this will factor in the future areas, whether the people collect, whether it is a technology licensing deals or whether because of our understanding, deeper integration with the technologies, that will pan out in due course. But naturally, as you know, we are not manufacturers of in any way. So we are just a technology developer.
Absolutely. But what I wanted to understand was whether order inquiries at least are increasing.
Sorry, can you repeat, please?
No, I just wanted to understand whether inquiries are increasing when it comes to sodium-ion battery technology.
Yes, yeah, absolutely. People are very curious. People do come specifically in India and outside India too. I think people are very curious. People want to understand more. So absolutely, as I said, as a technology provider, we are very keen to engage. We have to see what kind of engagement models come up.
Also, are you witnessing larger deals similar to the deals that you won from, say, a Renault and Honda during FY23?
I mean, I think I have been saying it in the past also that don't look at the deals. I think all our clients will scale to the similar levels, if not bigger. I mean, we have clients which are bigger than the names you have taken, the engagements. Not necessarily we will have one deal, but the point is, if you look at during this quarter, just to elaborate on that, we have closed $189 million of deal. It's a significant deal. I mean, I can very easily say it's a it includes a few 50 million or 100 million deal. But the point is, you have to look at the number. It's a 189 million new engagements which have been won during the quarter. So it just shows the very strong very strong momentum in the business.
So for FY25, broadly speaking, you'll be able to clock 25 to 30% kind of growth, or do you think it's going to be above 35%?
You may have to wait a little bit, a few months for that. But I must say that we see a very positive environment, and what the exact numbers will pan out, we will naturally talk at the end of this year, that is in April. But we see our client spending. We see where we are positioned very well. The technology area on which the spend in AR&D is increasing. Continue to increase. Let me put it like this: it continue to increase. So we see a positive environment. What exact numbers will be there, we will of course come back to you. But we see that environment in not only next year but next few years.
Okay, and in light of all of that, your margins as well have seen a steady improvement. What have been the drivers, and should we assume now that the margins will stabilize around 21% versus 20% in FY24?
See, we have been what we have been saying it. We wanted to achieve a 20% plus EBITDA during this year. Fortunately, we have exceeded it a bit. We always say that we have a good headroom, but we continue to invest into growth. Just like you have talked about, so the new technologies we are investing, new markets we are investing. So we'll continue to do that. So we are not maximizing our margins in that sense at the cost of future growth or future positioning of the company. So we continue to invest into technology and etc. So I would say we of course will continue to grow more than 20%, but what exact number in terms of profitability we'll give. But to your point, what are the drivers for that? Number one, of course, is the growth, which has been a very strong growth continuing and at a higher realization. So that is one important part. Second, of course, we have been in a position to really do operational efficiency, bring in a stronger operational efficiency. And third, we still have a lot of margin to really do more work remotely from the other development center that is there. Last but not the least, I think on the people side, our attrition has been all-time low. It is absolutely very low double-digit, if I have to say. So, I think that has all helped us to improve the profitability and manage our operations better.
Kishore, lastly, what message would you like to leave for your shareholders? Because yours has been one of the few rewarding stories within the IT and tech sector with almost over 100% return in the last 1 year alone.
Yeah, I think the point is, I must say that the fundamentals of our business are very strong, and we are here for a purpose which is deeper and longer. And we see that the investments in this area will continue to grow. We still have a lot of headroom, both with our current client as well as beyond it. And I think we'll continue to make the efforts and investments to be where we are and continue to give a consistent growth.
Okay, and I'm sure the stock is already taking cues from that, holding up a good 2.5% right now itself on trades, and the volumes as well clocked up pretty decent. Kishore, good having you on the show. Thank you so much for speaking with us today.
Thank you. Thank you. Thank you.
Okay, I just want to mark a Jyoti CNC. That stock is spiking up. No real reason or no news that is backing this, but nonetheless, can't help but mark that stock, given that you're seeing pretty massive traction and price action, double-digit gains on a Jyoti CNC in trade today. 462 scaled up all the way to about 522. Nova Agritech as well, that's the stock that needs to be mentioned, largely on the back of its listing today. And just taking a look at where that's settled at, it's a stellar premium actually that the stock has listed at, close to 57 rupees, and that's pretty much what the expectation is. The issue price was about 41 rupees, so a healthy premium is what you've seen Nova Agritech list at. Quick break, be right back, lots more lined up.